Welcome to the ResourceSpots.com podcast.
Hello, everybody. Thanks very much for joining us. I am Steve Strandsman, and as always, I'm joined by Carter Smith and Corey Fleck. Here are our topics for today. First off, we're going to talk about the conflicting viewpoints of Peter Schiff and Paul Krugman on hyperinflation. Following up that, we're going to discuss Obama's tax the rich concept and its viability. And finally, we'll end on Grover Norquist's tax pledge and how there seems to be a departure from hardline Tea Partyism on the right. For the first story, we'll go to Corey Fleck. Corey?
Thanks, Steve. This week, I chose to write my article on hyperinflation. There's been a lot of commentary back and forth on our website, including the KE report. And I figured that I wanted to really address this subject looking at it from two standpoints. First being Peter Schiff and the other being Paul Krugman. Now, Peter Schiff, we've had him on the show, on the website, plenty of times before. We know that he is very much takes a stance of hyperinflation is around the corner. He is a gold and silver bull. He thinks that really the currency will go back to the gold standard shortly, or at least he has taken that stance in a couple of his interviews. Paul Krugman is really on the polar opposite of that. He is really he is one of the most outspoken leftist economists, and he went and attacked Peter Schiff in his argument, saying that it's just not possible. It will not happen. Now, I broke down their two arguments, and Paul Krugman, essentially, he didn't prove to me a lot of what he was saying through his facts. He just more or less said it's not going to happen, and he attacked the Austrian school of thinking. Now, I thought this was totally unfair because it really has nothing, or I think it has very little to do with just strictly the Austrian school of thinking. I think it goes more into the details that Peter tried to outline and more of taking a broader view of things. Peter really says that the U.S. will be going through hyperinflation, or at least he called that. He has started to back down from that a little bit. However, he stands strong that we will go through high inflation, and therefore returning to the gold standard really isn't out of the question. Now, my arguments against Peter is that he's taking too narrow of a view. I think that there will be hyperinflation in the world. However, I think it'll go through many more channels before, if even, it hits the U.S. And I think it's far too early to say that the U.S. will go through hyperinflation. It's true that right now we are going through inflation. However, other parts of the world are going through exponentially higher inflation, which could also be called hyperinflation. We look at the crisis in the EU with their budget. They can't come and balance the budget. I think that they would be first, or they would fall before the U.S. into a hyperinflationary state. But also the yen, looking at that, they have really struggled recently. Their economy is in far worse shape than the U.S., and then looking just strictly at a world sense, there are still trade contracts out there in U.S. dollars. The U.S. dollar is the worldwide currency. It maintains that status. I find it just very hard to come to the conclusion that Peter Schiff argues that we are heading for hyperinflation. I think we will see another country go through hyperinflation first, possibly in the next year, but then we need to look at the contagion into the other currencies because we are so interconnected right now that it's hard to analyze what's going to happen further down the road because it's all about positioning when that first country or first currency goes into that hyperinflationary state.
It's hard to argue with either of these guys because they're both very intelligent individuals and they're both very big personalities whenever they're talking about these things. You can tell they've both studied and really done their homework, so to speak, on these topics. I agree with aspects of both of their arguments and what you're saying here, Corey. And the main takeaway for me is that to ignore the possibility on both sides would be irresponsible for us. We are definitely seeing things that are happening in the United States as well as the world economy that definitely are the telltale signs or indicative of the possibility of a hyperinflationary situation. That being said, Paul Krugman brings a lot of good points to the table as well about why it wouldn't happen, and why, even though there are a lot of the signs from the past that indicated a hyperinflationary cycle beginning, there are a lot of things about the situation now that are remarkably different that may indicate a possible different outcome. One main example that you mentioned being the fact that the United States is the world reserve currency. There are outstanding contracts that are denominated in U.S. dollars that will essentially prop the currency up for a longer period of time than it would normally go for. And this is an unprecedented situation in that. I mean, we've never had a currency that literally spanned the globe and tied economies and countries together.
I mean, and as all of these economies and countries get increasingly tied together, we see that the reliance on this kind of global currency just continues to grow. So I'm not sure that we can really look at the U.S. As a U.S. dollar as a reserve currency collapsing, and certainly not first, because too many people and too many countries rely on its solvency to continue to prevent a complete worldwide global collapse.
Okay, I think that's a good point. But I also want to bring up another point of one of Krugman's arguments, which was hyperinflation is essentially a massive increase in the money supply in the country. Now, everyone hears about QE and all this money being injected into the system. However, Krugman states that this is a liquidity trap, whereas this money, when they release QE3, more money didn't flow into everyone's bank account. More money came into the banking system so that it could be loaned out. Therefore, there is this initial bump in money supply out there. However, this money is owed back through, albeit low terms right now, but that means it's slowly getting paid back. So it's not going directly into goods and services. It's going back into the banks, which is taking away. Therefore, there is less demand for these products because people actually have less money to spend after QE goes through because they're paying this money back. So therefore, this almost has a deflationary trend. I'm not saying that they will go through deflation. However, it doesn't have the long-spanning inflationary properties that a true increase in money supply does.
Yeah, I thought that was a really interesting way of looking at it, and I thought that the idea of short term it can be inflationary, but long term it is deflationary, and I thought that that distinction was very interesting, really, in terms of just drawing that line in the sand there.
Another point that Skiff actually made was that the government, if it does not decrease in size, then spending will never be controlled. Spending is also what pushes the demand side because it's going out into the economy. This deals more with budgetary concerns, which we will touch on later in this podcast. However, I found this to be an interesting fact. And just to touch on one more fact is looking at the price of goods in the last couple of years. Yes, they have increased. However, they increased far less than the price of gold in the last 5 years. In the last 5 years, gold has more than doubled. Prices of goods have not more than doubled.
So what does that say to you?
To me, it says that gold is a better holder of your wealth. However, I don't think that proves that we're going through hyperinflation. We are going through inflation, which is not good for the currency, but we all see that. Hyperinflation is something that over time has been seen that in a 3-year span, currency is worth a fraction, a tenth of what it was before. So this 30% increase, which is a number that has been thrown out for the last couple of years, isn't hyperinflation. It is inflation, but we've been going through inflation for the last 20 years.
Yeah, I think that's a really good point. Moving on to the next article here, we're going to talk about Obama's taxing the rich concept and its viability. Carter?
Yeah, I wrote this article because lately I've been hearing a whole lot about the fiscal cliff, unfunded liabilities, sovereign debt, trickle-down economics, all that kind of thing. And, a lot of what has been kind of coming out of these conversations is this new idea that, in order to solve this problem, that the taxes on the rich need to be increased, or there needs to be a wealthy tax, or as I say in the in this article, a waxing, to make a little portmanteau there. But this idea isn't anything new. I mean, this has definitely been around for a very long time. But I wanted to kind of look at it a little bit more and look at some of the numbers and see, if this idea was actually viable. And I found a bunch of interesting articles out there. I found an interesting video kind of breaking down the numbers. And, when you're talking about trying to solve the problem of the deficit, right now, currently, since Obama's been in office, he's run trillion-dollar deficits every single year. Now, that is an incredible amount of money to even imagine. And we talked about kind of imagining the difference between trillions and billions last week. But all that aside, that's an enormous deficit for the federal government to be dealing with. Now, Obama's plan that he basically campaigned on and has now basically kind of turned into a mandate with his reelection is that he is saying that anybody earning over $250,000 or in the wealthiest tax bracket by his definition should pay by what he calls their fair share of the taxes. And so we kind of delved into it a little bit here. And from what I could see and from what economics professor Anthony Davies could see, the math just isn't there. Even if you increased the top 5% of income earning Americans to close to 90% of their income, you still couldn't pay down the federal deficit from this year alone.
But this is something that we talked about last week as well in terms of Warren Buffett's tax plan that he put into the New York Times last week, which is that this isn't necessarily the be-all and end-all answer, but rather a step in the right direction.
Well, this is the main point that I was trying to get to, was that it's not as simple as saying we just need to increase the taxes on the rich and the problem will be solved. Because as the math clearly points out, it's not there. That will not be enough. Like, you could bring it up to 90% on that top bracket, and it still would not be enough to cover just the deficit. That's not even talking about the debt. That's talking about this year's deficit. So right away we see that the math isn't there. Then, I mean, from a fundamental standpoint, how is that fair either when you have the top 5% of the population paying the equivalent of 30% of the total deficit or the total yearly revenue for the federal income? That just, to me, is not necessarily fair, because, I mean, essentially everybody's paying this, for the same services as far as like the federal government goes. So how should somebody have to pay more simply because they have more, right? Like, that's like going to a bakery, and because of the amount of money in your wallet, you get charged a different price.
Now, see, the argument that I had last week about Warren Buffett's plan was that the high income earners are paying a smaller percentage of their total income to taxes because of the different loopholes and the different way that capital gains, interest, dividends, all those get taxed at. I have no problem with bumping those up to a more reasonable number so that they are paying equivalent percentage to less wealthy people, we can call them. However, I think taxing all of these high wealthy people at high rates, like you said in your article, it will just chase them away. That's not the right. The fact of the matter is we're looking too much on the income side of things. The U.S. has spent exponentially more year over year over year. And why does that happen? How are they managing to spend so much more every year when their population isn't growing exponentially? And that they are actually taking in slightly more in taxes, but there's absolutely no way that you can keep up with spending exponentially more year over year.
So this was kind of my point, my concluding point here. Like you said, you can really only tax the rich like that once before they start to get scared and go away, either through, they relocate or they find ways of, hiding their income or tax evasion, that kind of thing. But the major point that I came to here was that this alone was not the answer. I mean, one of the major rules or unspoken rules rather, of federal budgets is that next year you're going to get at the very least no less than you got the year before. And then usually these federal agencies lobby to increase their budgets, right? So, I mean, from that kind of bureaucratic proliferation standpoint, you're seeing these bureaucracies that are kind of self-fulfilling, and no matter what, we use this much last year, we need to use this at least this much again this year, and possibly this much more because we didn't fulfill whatever mandate our federal agency was set out to do, right?
I think that, I mean, there are obviously immense problems on the expenditure side of the U.S. government, but I don't think that that necessarily goes hand in hand with not pumping up capital gains tax, for example, which would therefore bring the average percentage of the upper income bracket, upper tax bracket people to about the same as the less wealthy people, like Corey said. I think that in the grand scheme of things, the idea is not to tax the rich into oblivion, because I think, as you said in this article, that's a flawed plan. It's destined for failure. But what I do think is reasonable, and I do think is the kind of pillar of the Obama platform, was the idea that there should be an equal distribution of percent in terms of a percentage basis, regardless of how the money is made. And that's what we talked about last week as well, right, Corey?
Well, touching on Carter's fact there, where these lobbyists are really lobbying to increase their budgets year over year. These budgets should be funneled down into the people through higher wages, however the U.S. is spending their money into these programs and services, which is why we have these marginal tax rates, so that if people get paid more, they pay slightly more in taxes. Therefore, it goes back into the system. So it's this self-fulfilling proliferation here that really works, that they spend more money, but then they get some more back because people are paying more in taxes. Now, I think it's going to the point where it's showing that the government is getting too big. They're spending too much money on too many different services, so that they can't actually focus on what they need to spend their money on. And if they spend slightly more on that, that's okay, because they can make it back through maybe taxes in other ways. But they have just spread themselves so thin with so many different services and programs that they can't sustain this at all unless they cut.
Yeah, I don't think you're going to get any arguments from anybody here or anybody listening to this podcast that say that the government is too big or not too big, rather. So I can't agree with you more on that one.
Which this actually is a wonderful segue into our third and final article, which is the end of Norquist's no tax pledge. So Grover Norquist, the prominent conservative lobbyist and founder of Americans for Tax Reform, he's been one of the most vocal opponents to taxation. And he's the one who wrote the Taxpayer Protection Pledge. This is the pledge that has been signed by 95% of all outgoing members of Republican members of Congress and all but one Republican presidential nominee. And the pledge asks, and this is a quote there, one, to oppose any and all efforts to increase the marginal income tax rates for individuals and or businesses, and two, oppose any net reduction or elimination of deductions and credits unless matched dollar for dollar by further reducing tax rates. Now, this is a hard line stance that Grover Norquist takes, and he's taken it for a long time. As I said, 95% of the Republican members of Congress that are currently sitting have signed this pledge. Now, in the upcoming 113th Congress that the American public just voted on, the number who have signed the pledge has dropped from 243 down to 219 in the House, and down to 9 from 41 in the Senate. This has been a pretty significant drop, obviously. And what we're seeing is that a lot of Republicans are backing off this hard party line of never voting for a tax increase. I think that they're looking at the fiscal cliff, staring at it in the face and saying the only way we're going to deal with this reasonably is we have to be open to the idea of raising tax rates, or open to the idea of at least having a discussion about raising tax rates. Now, Norquist is still standing up and saying, don't worry, nobody's voted yet. Nobody's voted for a tax increase. Let's not go crazy. My pledge is still relevant. But at the end of the day, These are real decisions that people have to make about the betterment of the country. And I think that if Norquist's tax pledge is to stay in place, he's really jeopardizing the future of America.
Well, there's absolutely no doubt in my mind that this is quite preposterous, just simply from what we've said, that there needs to be a two-way street here. There's too much spending going on. So unless they cut spending, then how can they possibly completely disregard raising taxes? It's way too one-sided thinking. I'd love to sit down with Norquist and ask him where he thinks that they're going to make up the $1 trillion deficit year over year from if they're not going to take in any extra income whatsoever.
Yeah, that's a really good point. I'd like to actually know, I was reading through the article here, who was the one Republican presidential nominee who didn't sign this, because this to me is really kind of the epitome of what is wrong with American politics right now. And, this is just one example, and there's examples that are on both sides of the fence of really just kind of staunch, digging in your heels, no compromise kind of attitudes. And it's really kind of started to epitomize what is the American political system, in that, like, people are just completely unwilling to give on a number of issues, and that's not what it's about, or that's not what it should be about. I mean, America was basically founded on compromise, and I think without compromise and a little bit of give and take from both sides, we're going to find ourselves to be even more polarized than we are right now.
I couldn't agree more. And just to fill you in there, the one Republican nominee who did not accept and sign the pledge was John Huntsman.
John Huntsman.
Yeah.
Wow.
There he was. So I think your point there is entirely right. And in fact, Ezra Klein over at the Washington Post actually says that he believes that Norquist actually knew that this pledge was bound to fall. And he came into this with the idea that this pledge was designed just to keep tax rates lower than they should be for an extended period of time, and to try to draw out the process as long as possible. Which plays into his personal gain and plays into the personal gain of people who support him and his party, or rather his lobbying group. And I think that, like, him as a lobbyist to do that is, number one, points into a big problem of lobbying in the U.S. political system, but it also just shows, as Carter said, that we need people who are less influenced by outside sources, less, ideologically diametrically opposed to one another, and rather come at this in a way that is productive and conducive to growing the American economy.
Yeah, we need less polarization in the U.S. political system. Quite frankly, both parties are just digging their heels in, and then we also have these Tea Partyists that are just taking this stance that they know that neither party can fully embrace, and then neither party really wants to fully embrace it because the other one will attack them on this stance. And like you said, he's not throwing this out there for the betterment of moving closer to a balanced budget. He's throwing it out there to cause waves, to make both parties look bad, which somehow in some roundabout way makes him look better.
All right, well, we've got a fiery discussion here this week. I gotta tell you, it's been a fun one. Coming up next, Corey will be chatting with Al Korelin of the Korelin Economics Report. And one more thing before we get out of here, make sure you head over to resourcespots.com and check in at the Pulse Poll question, where the question is, what will be resolved first, the U.S. fiscal cliff or the EU budget crisis? Check in there, and we'll be back right after this.
All right, welcome in, everybody. My name is Corey Fleck, and today I am joined by Al Korelin. You all know him as the founder and host of the Korelin Economics Report. Now, Al and I have been working more and more closely together, bringing our thoughts together and giving you guys an idea of what we think the market's going to do moving forward and kind of how the economy is positioning itself. Now, Al, I have some questions that I want to bring up from some listeners, and I was hoping we could chat about those. First of all, I wanted to chat about a letter that you said, or actually an email that you said a listener sent us on the consensus on Wall Street is that gold was going to hang around 1800, just above 1800 range in 2013, so next year, and then in 2014 going to drop down to about the $1,700 range. What are your thoughts on that there, Al?
Well, the general consensus right now is that gold will remain strong in 2013, maybe slack off a little bit in 2014, but here's a really interesting comment here. BNP Paribas came out and they lowered their expectations for gold in 2013, but they lowered it to a price that, to me, makes all the sense in the world. You know, and therefore they were forecasting before somewhere around $1,900 an ounce, and they are now saying, the bank is now saying that in 2013 we're looking at around $1,800, and $6,500 an ounce, and then they're expecting gold prices to be in the high $1,700 per ounce range in 2014. Now, I have to tell you, I have absolutely no problem with that, and I'll tell you why. I think gold stabilizing in the 1750 to 1850 range is very, very good. I think it's very, very healthy. I think it indicates that the economy may not implode. And I have to tell you, Corey, I think that in terms of investing in the resource sector with prices like that, I think the resource sector, as John Kaiser mentioned in the previous segment, could be a very, very good place to be in 2013, and I'm putting my money where my mouth is.
Yeah, I actually quite agreed with what John had to say on the resource market in 2013, and I also like your comment there about gold stabilizing. Silver will obviously move in parallel to that, so raising, obviously stabilizing as well, although we know that it is the more volatile metal. However, without calling for the gold hitting 2,500 and these really outrageously high numbers, it's showing that the economy, at least in the U.S. and around the world, isn't going to collapse, which I don't want the economy to collapse,
no.
Obviously. However, I do like these high gold prices because they're founded. We keep on talking a lot about this hyperinflation and everything in the U.S. costing more and more. It would be nice if that could all kind of be under control. Even if we are paying more for goods now, it would be nice if we could at least forecast out some sort of stability, don't you think?
I do. You know, it's funny, but you and I and the guys have been talking about the general philosophy right now throughout North America, and the general philosophy certainly as expressed on our website, and a lot of people are, you know, people look for opportunities. There's a certain segment of the population, however, that basically all they want to do is complain. And in my humble opinion, complaining never got anybody any place. And, you know, we have an environment right now where the economy is in very rough shape. We have an environment right now where the resource sector is taking a real beating. But, you know, as Doug Casey said in his book, Crisis Investing, that was a New York Times bestseller back in the late 1970s, early 1980s, crisis, according to the Chinese philosophy, crisis always equals opportunity. And, you know, I saw that firsthand, Corey, back in 2008, 2009, when Kathy and I just kind of held our breaths, collective breaths, and invested in some of these little companies. And 2010 turned out to be a great year for us. I think the same thing is going to happen in 2013. And again, I don't mean to repeat myself, but, you know, we're putting our collective, you know, we're putting our money where our mouths are. People really, survival is an incredibly strong instinct, and people are going to want to survive. And whether that means, you know, purchasing and maintaining a stash, for lack of better terms, of gold and silver, or whether that translates into purchasing resource stocks because of the potential leverage available there, leverage to the price of gold and silver. You know, I think we're going to see some action, and I think that people are going to begin to take action, not necessarily because they believe that the market or that economic conditions are necessarily getting better and better, but they're starting to realize, they're not really getting a hell of a lot worse. And it's certainly, whether you agree or disagree with the current administration, and I don't happen to disagree, I don't happen to agree with their philosophy, but that it doesn't matter. It's not in their best interest either for this economy to collapse. And so I think we have a number of things going in our favor, Corey. I really do.
Well, yeah, sticking on kind of the investment side of things, and I think everybody knows that we are pretty heavily invested in junior resource, besides actual physical, but the actual junior resource industry. We've seen a lot of people exiting that industry. And there's always the investing philosophy of put your money where people are scared to put theirs, because when it is an industry that has been around essentially forever, which mining and exploration have been, then it's going to sustain itself. It's not like you're betting on the next Google bubble or anything like that. You're betting in an industry that has been around forever. And right now, we've heard many people say that it might be a little bit saturated, but that doesn't mean that there are not good companies still out there. And we see a lot of companies come by us every day, every time we're at one of these shows, and there are good companies out there. And the fact of the matter is everybody is beat up. But when we see some sort of stability, and I like what you're saying, that the administration really does want some stability, and so does everybody, then we will see that money come flowing back into the market, and hopefully it is kind of a mirror to, or exactly what happened in right after kind of the crash in 2008, is that money comes back and these good quality companies recover.
Yeah. I have to say that I'm not necessarily disagreeing with our listeners when they say that, the economy is still a house of cards. The emperor still isn't wearing any clothes. And that's true. But, you have to understand that this didn't start with the current administration. It didn't start with the prior administration. This trend has been going on for quite some time now. And I would like to believe that the survival instinct that is expressed by, or that I should say we witness in humanity, is alive and strong. And I think that people are going to basically say, all right, it is what it is. We don't agree with a lot of the policies, but you know what? Within the current framework, we still think that we can do this and this and this and profit. Corey, thanks for your time, buddy.
Yeah, thank you so much. We'll chat again soon.
All right, everybody, that's it. Another week and another episode of the ResourceSpots.com podcast. Make sure you subscribe us if you like it. Let us know in the comments below. Check in at KEReport.com, at ResourceSpots.com, and we'll be back with another episode next week. See you then.
For exclusive video, radio, and written content on commodities investing, visit ResourceSpots.com. ResourceSpots.com, superior commodities investment insight.